All right. Welcome to the Real Estate Life podcast. So today on this podcast, we're dedicated to creating a life of passive income to real estate and doing something that we love along the way. And today we have a very special guest, Rod Khleif. Rod has been someone I've been following for the last couple of years in my career. I've learned a lot from him, and I can't wait for you folks to hear his story. And I hope you guys could share the same stuff I learned from him. Rod, welcome to the show.
Oh, thanks for having me, brother. I'm really looking forward to this. Let's have some fun and add some value.
Yeah, let's do it, man. So, Rod, there's something that caught my attention. It was your story, your 2008 story, and the reason why is because I also got into the real estate business 2 years right before the 2008 happened. And for those that weren't around for that era, it was a very painful lesson. Can you share a little bit of your background and your story and how we got to this place right now?
Sure. Well, it's a painful story, but but let me go way back. So I immigrated to this country when I was 6 years old with my brother Albert and my mother's Vantje. I was born in the Netherlands, in Holland, wooden shoes, windmills, and we ended up in Denver, Colorado, where I lived for 30 years. But when we first got there, we really struggled. I remember eating expired food because that's what we could afford. We had powdered milk with our cereal in the morning because that was cheaper than real milk. I wore clothes from the Goodwill and the Salvation Army literally all the way through junior high school till I lied about my age when I was 14 because I was tall and got a job at Burger King. And so I could buy my own clothes and ultimately hopefully buy a car. And so we struggled. And I'm sure, you've got listeners that had it harder than we did, or maybe have it harder now with all this COVID nonsense. But, I knew I wanted more. And luckily my mom had an incredible work ethic. So she babysat kids so we'd have enough money to eat. And with her babysitting money, she was a bit of an entrepreneur. She invested in the stock market and made money, but she also invested in real estate. Her first house was right across the street from us. We bought from a neighbor. And she bought it for approximately $30,000 when I was about 14. When I was 17, she told me it had gone up 20,000. It was that she'd made $20,000 in her sleep. And I'm like, what? Screw college, Mom. I'm getting into real estate. So I got my real estate broker's license right when I turned 18. I was going to be rich selling other people's houses. And my first year in real estate, I made about $8,000. My second year, maybe 10 grand. But my third year, I made over 100,000, which back in 1981 was pretty decent change. And so what happened between year 2 and year 3? Well, what happened was I met somebody that taught me about the importance of mindset and psychology. And, anybody that listens to me knows that I'm a huge proponent. And my belief is 80 to 90% of your success in anything, certainly financial success, but even relationships, everything else, is mindset and psychology. And so fast forward to today, I've owned over 2,000 houses that I've rented long-term in 3 states. I've owned thousands of apartment units. In 2006, my net worth went up $17 million while I slept. And if you do the math on that, it's like $8,300 an hour over a 40-hour work week for the year. And of course I did. And, anybody that holds still long enough heard about this big win. And I got a head so big I could barely fit it through a door. I thought I was a real estate god. Well, when that happens, God or whatever you believe will give you a nice little smack. Well, that was 2008. Like you said, I lost $50 million in 2008. I lost everything. And, so what I'm known for is talking about, the mindset it took to have 50 million to lose in the first place. And then the mindset it took to get back to the success, to recover from that and get back to the success that I'm blessed to have today. But that's the story. And it's a painful story, but, a lot of people fear failure. And I'm going to tell you, fear regret a lot more than failure. We fail our way to success. Any entrepreneur knows that we you fail a lot. And they're seminars. I call them seminars. I don't call them failures. I've actually built, a lot of people don't know this. I've built 27 different businesses, startups, and several were worth tens of millions of dollars. Most spectacular flaming seminars. But, in fact, as an aside, one more little note, I met the billionaire owner of Spanx at a mastermind that I went to. I believe in masterminds and boot camps and so on. And I met her, Sarah Blakely. She had started with $5,000 and now she's worth, I don't know, 4 or 5 billion. And she told me that her dad used to ask her and her brother on a weekly basis, what have you failed at this week? Which to me is just such an awesome freaking question to ask your kids, not to fear failure. But anyway, so that's my 2008 story.
That's pretty neat. Now, talking about that failure. Now we've had a great run in real estate. Actually, the run has actually exceeded my expectation. I honestly couldn't think it had gone this far.
Me
So
too.
I'm at the edge of my seat right now. Like I'm freaking out.
Oh, it's coming. It's coming. It's
Okay.
coming.
So,
Trust me.
So that's, I don't know if things just don't make sense to me. I'm looking at the inflation. I'm looking what residential is trading for. I'm looking at people buying these assets that, they just doesn't seem they could afford, even though the financing is a little bit more stricter. The guidelines are stricter. Interest rates are extremely low, but it's become so competitive. So anyone that's getting into a multifamily space, or even seasoned veterans, when I'm underwriting deals and I see deals that I lose, which I'm losing quite a lot lately, I start to think like, what's going on here? Like what's happening? What are these people seeing that I'm not? What can you advise investors, advise me also, what mistakes you're seeing out there that you see them all the time?
Oh, well, no, same thing you're seeing. We're kissing about 300 frogs to find a deal right now. And it used to be 100. Now it's 300. And, I'm blessed because of the success of my podcast. Like I was telling you earlier, we broke 11 million downloads. I have about 1,000 students around the country that send deals to me. So, I mean, we're plus brokers and everything else. So I'm kind of in a unique situation that I see probably a lot more deals than most people see. And I will tell you, and we'll be in best and final on a deal. For those of you who don't know what that means, it means, they'll pick the top 5 offers and they'll say, okay, this is your best offer. And we come in there and a little more aggressive sometimes than I like. And we're like shaking our heads, scratching our heads, and we see what these properties trade for. And so, I will tell you, I think there are a lot of questionable deals happening right now. I think there's irrational exuberance. Now, here's the caveat, and I've been through 3 of these crashes. Okay. And of course, 08, 09 was the big one, but even back in the late 80s, went through some significant crashes. There was the S&L crash. And so I've been through a few of these. I'm 61. I'll tell you that, first of all, real estate, like the weather, goes through seasons. It goes through cycles, and to think that this is going to last forever is naive. Okay. In fact, this kind of feels like 2006 and 7 to me. I will tell you, it feels like it's frothing to me. Now, is that something to fear? Is that something to stop investing? No, it's something to be aware of. It's actually a fantastic time to learn this business. And because I will tell you, if you listen to my podcast, I've interviewed the biggest players in the country. Humbly, I really have. I mean, people with 20,000 doors, 100,000 doors, and just billionaires. But if you listen to like the biggest chunk, which has like 3,000 to 6,000 doors that I've interviewed, most of them started in 9, 10, and 11. It's what we call a clue, right? But let me say this as it relates to, people, because I'll get people say, should I wait to invest? And I'll say, no, it's a great time to learn the business and build connections and build relationships and understand how to look at deals and so on and so forth. Because I'm coming from an education mindset, because that's what I do. I do live events. I do boot camps. I have, like I said, I have coaching students and so when I'm talking to my students, I'm saying, no, this is the best time to learn, because if the market does correct, with crisis comes opportunity, and there will be incredible opportunity. But there are deals. I mean, I was telling you before we started recording, we've got a deal right now that in San Antonio, it's 296 doors, and we just closed on it last week. We still need to raise some equity. So I'll let your listeners know if they want to check it out, they can, but we still need to raise a couple million, but we closed last week. But here's the thing, that deal breaks even today, before we do anything, at about 42% vacant. So 58% occupied, that thing breaks even day one before we do anything. And there's all kinds of value add opportunity there.
That's including the debt?
Everything, debt, everything.
Oh, wow,
yes,
great.
yes. I mean, it's and that, which is unheard of in this market. Okay, that's and I'll give you another tip here. I mean, another piece of this. Most deals that are being done right now, the split is in the 70-30, 80-20 range towards the investors. And of course, the investors like to hear that. But what they don't realize is that the deals are being structured that way because they have to be to get the returns that the investors need. We're at 50-50 on ours, and we're still at, extremely conservatively. And everybody says they're conservative, but we are really conservative. At minimum, probably in the 10 to 12 range, cash on cash, 15 to 17 IRR. And that's being conservative. It's significantly conservative.
What are you giving investors on that deal? What's the deal
eight pref, and then the return, and then the 50-50, and those are the returns. And so, if anyone's interested,
50-50, your 50-50 comes in after when? Is that a hurdle?
After the 8 pref. Yeah. After the 8 pref. Yeah. So they get the first 8%, and then it's split 50-50, and we're still able to project those kinds of returns at a 50-50, where again, most operators have to come in at 70-30, 80-20 to make the deal work. This deal is that conservative. Now, if you're interested in that deal, text partner to 72345, or you can go to creecap.com and see the presentation we did on it. We still need to raise a couple of million. I've been busy with 2 live events, and my partner's been busy with his son getting married and all kinds of stuff. So we haven't really touch base on that.
To touch base on that deal, I'll act like an investor on this deal, and I want to ask you quickly.
Sure.
Where did you see the opportunity in this deal, and how much of a bump up per unit can you get by doing value add?
There's all sorts of value add on this thing. First of all, that market, the rents went up 18%. While we were under contract, the property improved so much, and when our money was hard, they dropped the management company. One person was in the office. It's supposed to have 3, and there was 1, and still the property performed so much better than when it went under contract than when we closed that it impacted our loan proceeds. We were able to, deal with, we had an increase in the insurance because there's been a lot of storms and stuff. So we had a $50 per unit increase in the insurance. And because the property is performing so much better, it didn't impact our loan proceeds at all. But which is very unusual as well, that the property improves while it's under contract, and in light of the fact that there was nobody there to work the property. So, but anyway, we're being super conservative on the rent bumps on this thing. And I don't have the pro forma here in front of me. I can tell you how we mapped it out, but we show obviously higher vacancy the first 3 years, because we're doing our reposition, our first 2 years actually, because we're doing our reposition to improve these units and put in the normal, the LVT flooring, the resurfaced countertops, the appliance package, the fixtures, and so on and so forth. But this property has a lot of peripheral opportunity as well. Okay, there's a real opportunity for preferred parking there, and no question people are going to clamor for it. So we're going to stripe the parking lot and number all the parking spaces, and then we'll let people know, hey, first come first serve. If you want to reserve your own spot, come in here. It's whatever it is, $20-30 a month, and you can reserve a spot. There's also an incredible opportunity there for covered parking. It's it's Texas, and it gets hot. Okay, so we're gonna have covered parking in a couple of areas. Every unit has washer dryer hookups, but not every unit has washers and dryers. So if somebody wants a washer and dryer, we'll throw it in and rent that out. But there's also an opportunity for self-storage on the property in the back corner. And so we're going to do a survey and see what the interest is. I think it'll be high. And that we didn't even include that in the pro forma. I mean, we didn't even include the potential self-storage revenue. So, it's just a really solid, super conservative, but very, robust deal as far as returns are concerned. But again, much more conservative than normal. But back to your question about inflation or about the market where we are right now. And let me talk about inflation. So this is the beautiful thing about our business, Abiel, as you know, and that is, I don't think there's a better hedge against inflation than than cash flowing real estate, because as everything goes up in price, so do rents, right? And the debt doesn't necessarily go up. It depends on what, we've got 10-year fixed debt at 3.2, I think, on that. We hit the commitment right at the perfect moment when the 10-year
Fannie or Freddie or
Fannie. Yeah. And our model, and a lot of operators are in there to buy and sell and make a quick buck. Our model really is lifetime cash flow. That's the name of my podcast, Lifetime Cash Flow, for a reason. And so what we do is is in year 3 or 4, we will put a supplemental loan on and get our investors most or maybe even all their money back. And then they're in the deal, you know, for really the returns are infinity if they've got all their money back. So, you know, that's our model. Now we keep an eye on the market. Okay. You know, if the market starts to shift, then we're out. But if the market stays stable or improves, then why? I mean, you know,
let me touch base on that, Rod, because I'll tell you, it is very tempting when you're an investor that's trying to double up on their money and to not be tempted to sell these deals, because you know you're getting constantly bombarded with offers. Not everyone, you know, especially when you're young and you want to double your money. What do you say to those investors? And I say that because that's me. Like you know,
you know, I will tell you that if you can not have any investment in a deal and be making cash flow from that deal, I mean, forgive me, but I don't think it gets any better than that personally. Yeah, you might make a quick little hit, but you know, I regret every property I ever sold, every property. And I will tell you, my first interview on my podcast was with a billionaire named Abiel Ballesteros. And I mean, he's forgotten more about this business than most people will ever know. And he, you know, and he said the same thing. He said, you know, I'm a real estate buyer, not a seller. In fact, I'll tell you a fun little side note. I host a mastermind. It's pretty sure it's the largest multifamily mastermind out there right now. We've got about 14 billion in assets, and he's one of the members. And my team called my assistant called his assistant and said, hey, you know, we want to fly Albert down first class and we'll put him up at the Ritz so he can come speak to the members. And his assistant's like, oh, no. He'll bring his own jet down. Thank you. Like, oh, good Lord. Love it. Anyway, but yeah. I digress. But yeah, as far as where we are on the market cycle, it's not a thing to fear. There are deals out there, as evidenced by the one I just talked about. And again, if you're interested, text partner to 72345. I'd love to chat with you about it, or go to creecap.com. But be that as it may, don't be in fear right now. And that's the thing. I think there's a lot of fear out there with COVID and everything else. Look how resilient this asset class was for COVID. You can't say the same thing about retail or office. Even, you know, they got their butts kicked. Everybody's working virtually now, and retail, you know, we all know what's happened there. So
I'll tell you, we did see a lot of opportunities during COVID. There was a lot of distressed multifamilies that went out there, just poorly structured deals, investors that just weren't well capitalized.
Okay.
Yeah. They were relying, which is a mistake I see a lot in the business. For those that are listening, you got to be careful with those investors that are relying on rents to rehab their property. That is a no-no.
That's a no. Huge mistake. You never rehab a property on cash flow. You always raise the money in advance. Super newbie mistake.
You see a lot of that.
And you don't totally bank on rent increases. Okay. You know, you've got to be careful with, you know, you'll see 3% bump every year on a deal. And, you know, who knows if that's real.
What's a good breaking point for a listener to listen out there when they're underwriting their deal and they're being, there has to be a point where you says, all right, worst case scenario, this is the percentage that I just can't pass.
Yeah. I will tell you, you know, it depends on, it's so market driven. It's impossible for me to answer that globally, but you know, there's some markets that are seeing huge, and I mean, of course, this last year has been insane. Like I said, San Antonio, where this deal is we're talking about, it went up 18%, which is just Texas staggering. Yeah, I mean, so and a lot of markets did, but you know, I don't know that I can answer that question. It's so deal specific. It's asset class specific as well.
Correct. I agree with you.
And you know, so if you found distressed, you're in distressed stuff, right?
Yeah, that's what we love. We buy distressed. We're buying 40, 50. Yeah, it's C. We have some B's. Our discounts are 45, 50%. Wow. We are walking into, we have purchased properties that had 30% occupancy, that they were going through a heavy lift and just they had some issues, the owners. So that is our reputation. We have a strong background in construction. That's mostly been our target. We like to acquire properties in receivership. It's for those that don't know what receivership is, these are properties that bank is trying to take possession of it. The courts have taken control of property. That's our niche. You know, we get down and dirty with those. We like those a lot because of the discounts.
Love it.
but they're not for
now,
everyone.
there's a lot of risk with those. I mean,
Yeah, they are.
for an unseasoned operator, it can be a recipe for disaster.
Correct.
But you obviously know what you're doing, and as long as you discover why the property's in receivership is the big thing. If it's if it's not area, if it's something that you can control, if it's not functional obsolescence, rooms are too small for the area, ceilings too low, poor systems, whatever. Then yeah, they can absolutely be a home. I mean, I bought tons of distressed stuff, not as much multi as single family, tons of single family distressed stuff.
It is tough. They are less attractive to investors, and not everyone has a stomach for them.
Well, they're higher risk. They're certainly higher risk, but they can also be higher reward too. The thing that I'm careful of is I don't do any C- or D, because I've had some horrible experiences. I mean, I've had people killed in them, killed around them.
I agree.
Holes cut in the door to pass the crack through. I mean, I could go on and on that.
I've had windows stolen from my properties. Just off the frame.
Copper, steal all the copper. I mean, and some of these distressed areas are, very poor. And we've got an asset in Louisiana I probably should have avoided, frankly. We just got such an incredible deal on it. My partner talked me into it, but the owner paid 20 grand. I'm sorry, the owner paid 20 million 10 years ago. We got it for 16 and a half. But had a real problem. I can digress down that story. It was. Management. I had a partner that had a management company, and I shouldn't have let him manage it. He just so we took it over, and we've tripled the revenue.
It's not for every manager.
No.
Now I have a question, which is this one's always been tough for me because there's so much different data all over the internet about this specific question, which is what asset class performs the best in a recession or a down cycle, if you want to call it a down cycle.
It's no question it's multifamily, Abiel. I mean, what else is the government helping support?
I wanted to say Class A, Class B, or apartments. Which of those have you experienced that have performed?
I will tell you, it depends on what caused the recession. In COVID, it was obviously A and B properties did much better than C because the demographic in the C properties are the ones that got their butts kicked. Restaurant workers and hospitality workers got killed, and they were in C and D assets. So the COVID recession, certainly A and B is better. Now, in 2008, I didn't have any A-class assets, but I heard that they did get hurt because people basically went down to spend less money and combined families and did all sorts of things to live, below their means or within their means. But I'm not an expert to speak about that.
Yeah, it's hard to define it. And it's a question I get asked a lot by investors. And I could just say that, I'm just not in that Class A market to understand how bad they're getting hit. But overall, Class C, I think everyone's affected. I would not buy Class C right now. And respectfully, I just think COVID is here to stay. I think this administration is working it a little bit, but let's not go down that rabbit hole. But anyway, Tell me about this Ohio deal. You just got hit. You got hit by a tornado.
Oh, that's a funny story. So funny now. I bought a 101 unit complex up in Beaver Creek, Ohio, and literally months after we bought it, the team called and said, "Hey, we got we had a tornado hit." So I fly up there the next day. I'm driving down the street and I see there's no damage. There's no damage. Then I get to the complex and it is freaking destroyed. Okay. And thank God nobody died. We had a couple people seriously injured. I talked to a lady. She was all 101 families had to move. Everybody's out. Okay. Wow. There's no power. Everything's, it was just an unbelievable logistical nightmare. But I actually had a worse logistical nightmare with a hurricane here in Charlotte County, but where I own 350 houses. But let's stick with the apartment. But anyway, I get there and there's this lady pulling her stuff out of the house because she has no power and she, and there's water and everything and just a mess. And she told me that she was asleep on the couch and her son was up playing video games and luckily the early warnings thing went off on his phone. And so he heard it beeping. He walked downstairs by the time he woke her up, his bedroom had been blown away.
That's incredible.
Yeah. And thank God no kids got injured. But we did have a couple of people that had to have surgery. They're okay now, but wasn't fun for them. But so the moral of the story here, it speaks to the beautiful nature of our business, because we were able to, now, we obviously had to rebuild. We didn't change any of the floor plans or anything. This was already a really nice townhouse project, but we were able to put really nice finishes in and things like that. And we got a $650 rent bump. So do the math on that. It's a $12 million increase in value on a 100-unit complex, 101 units, which is a little unusual. So that would turned out to be a huge home run.
Because you ended up repositioning all new tenants.
Yeah. Oh, yeah. No, totally.
That's the reason why you were able to get the bump up.
Place was empty. So
you started from scratch.
Right. Right. And it's in a, it's in a suburb of Dayton. Dayton is probably not a market I would pick as a target market, but this is a very wealthy suburb. It's right by the base there. It's just turned out to be a big home run for us. Now we've seen those kind of swings on other complexes. I got a Dallas asset that was 208 units. We got a $250 rent up. So that's a $10 million increase. But that's why we like this business. And those of you who don't know, the beautiful thing about this business is that the value is based on a multiple of the net income, the net operating income. And so any increase to that net income is about a $17 to $20 increase in value. And so, it's exponential. And so, and very few assets that you can buy that you can force the appreciation. You can't do that with, obviously with residential multifamily of any kind or single family, because you're based on the value being based on comparable sales. Well, in this case, it's totally based on income. So any improvement to that income is, and that's
forced
why
appreciation is my favorite.
Right. Right. Yeah. Absolutely.
If you could tap into that business, you're going to kill it.
Exactly.
Rod, you have an event coming up here in Orlando.
Oh, thanks.
In December.
Yeah.
I would like the listeners to know what the event is about and what they should expect.
No, I appreciate it. So it's a 3-day boot camp, and it's not a sales pitch, and I talk about my coaching for about 45 minutes. Okay. There's the sales pitch. But I will say this, my students, I've been teaching just under 4 years. My students own 45, I think actually closer to 46,000 units now that we know of. There may be more than that, but 46,000 units in 4 years. So I'm really proud of that, number one. But my events, every one of them has sold out. I was supposed to have a live event in Orlando, May of 2020. We all know what happened with that. Yeah, and I had a bunch of people signed up. I was freaking out, like, what are we going to do? So I went to virtual. I built a video studio here in my compound here in Florida. But so we've got a live event December 3rd, 4th, and 5th. It is, we go through every aspect of the business, finding deals, evaluating those deals, the due diligence, financing the deals, getting the funding you need for the deals, how to syndicate, how to joint venture, how to manage. And then, I'm known for mindset. So I spend a lot of time on mindset as well, because you've got to take action with what you learn. It's not, if it was just knowledge, there'd be a bunch of wealthy librarians and college professors out there. You actually have to do something. So I've got a phenomenal deal right now. Actually, if you're going to go live on Monday, this is perfect, because if you remember this, guys, okay, it's rodinorlando.com or text Rod in Orlando to 72345, but use the code RODFRIEND and you can come for $150, $147. Okay.
I'll drop the link for the listeners.
It's kind of a duh. Okay. $147 for 3 full days of training. Now it's drinking through a fire hose. I'm going to tell you, I've got the manual. Here's the manual. So it's this one. You can get an idea. Awesome. I mean, it's awesome. 220 pages or something. It's not some fluffy thing. I give you everything I've got in those 3 days. People rave about it.
I want to add something about this type of class, because it's not just for someone that wants to do the business. Let's say you want to invest. You don't want to be hands-on, but you want to find the right syndicator, the right person to do a joint venture with. These things are important for you to learn, because you're going to know the lingo. You're going to know what they're talking about. You're not going to be blinded by something. If something goes wrong, you got to educate yourself, even if you're not going to be hands-on.
I'd like to expand on that. I'd like to expand on what you just said. If you're going to give your freaking hard-earned money to somebody, for God's sakes, have some basic understanding of what it is they're doing. And so I get a lot of people that just want to invest passively that come to my events to learn the business. And it's a lot of fun. I'm going to tell you, I mean, I keep it really entertaining, high energy the whole time. I face plan on Monday. I will tell you that, but I will tell you, those 3 days, you get everything. And I've never had a complaint other than the freaking room's too cold or something, or they didn't like the food at dinner or something. But
you picked a great location. Orlando's awesome.
Yeah, it'll be fun. And Yeah, you'll love it. But again, it's rodinorlando.com or text Rod in Orlando to 72345. And remember the code RODFRIEND, and it's basically half price. Or it's like $147, which is, again, just stupid cheap. So,
and how can they get in touch on this deal that you have now in the pipeline?
Yeah. So yeah, if you're accredited, we can only do accredited. If you're accredited, text the word partner to 72345, or go to that creecap.com and there's the presentation you can watch. But just text it and we'll get you set up with a call or send you the link so you can watch the presentation.
What's the minimum investment on that?
100,000.
100,000. For those who are listening to, take a look at that deal. After hearing them talk about it, sounds very encouraging. Rod, it was a pleasure talking to you. I mean, man, this is awesome. I've been following you for many years, and I finally got to talk to you, man. Thanks for
Thank you for your kind words, buddy. It's great to meet you, and hopefully I'll see you in Orlando because there'll be a ton of people there. You should, if you can come, please come as my guest.
I'll take you up on that. Thank you.